The Federal Reserve is making the most dangerous macro bet of the decade, and it is happening right now in April 2026. While central banks gamble, they have time on inflation risks. Transformative AI is rewriting every assumption in their economic models. This is not a theoretical debate. In the next 48 hours, the FOMC decision on Wednesday will collide with GDP and PCE data releases, creating a repricing event that will separate smart money from dumb money. Here is what institutional desks already know that retail investors are missing. The Fed's current stance assumes traditional macro relationships still hold. They are betting that productivity, inflation, and employment move in predictable patterns. But transformative AI is shattering these correlations in real time. When AI-driven productivity surges, it creates deflationary pressure on goods, while simultaneously driving asset inflation in tech equities and digital assets. The Fed's models were not built for this. Let me show you the data cross-verification that proves this divergence. First, look at the Producer Price Index for April 2026. Core PPI is running 180 basis points below the Fed's December projections, driven by AI automation in manufacturing and logistics. Meanwhile, the Nasdaq 100 is trading at 28 times forward earnings, a valuation only justified if AI productivity gains are permanent and accelerating. Second, examine the Employment Cost Index. Wage growth in AI-adjacent sectors is running at 12% annually, while traditional sectors show 3% growth. This bifurcation means aggregate inflation data is masking a structural shift the Fed cannot address with blanket rate policy. The central bank is flying blind, using instruments designed for the 20th century economy. Now let me translate this macro setup into actionable positioning. Smart money is not waiting for the Fed to figure this out. 3 tickers are positioned at the epicenter of this repricing event. First, QQQ, the Nasdaq 100 ETF. If the Fed signals they underestimated AI's deflationary impact, tech multiples will expand violently as rate cut expectations accelerate. But if they acknowledge the productivity boom and hold rates longer, you will see a 12% correction as growth assumptions reset. Second, IBIT, the iShares Bitcoin Trust. Bitcoin is trading as a pure macro volatility instrument in April 2026. The 48-hour data cascade will force a repricing based on whether the Fed treats AI deflation as transitory or structural. Institutional desks are using Bitcoin as a hedge against Fed policy error in both directions. Third, TLT, the 20-year Treasury ETF. The yield curve is pricing in 3 rate cuts by year-end, but if AI productivity is real and persistent, long-duration bonds will sell off as growth expectations rise and inflation floors stabilize higher than the Fed projects. This is the smart money trade, positioning for whipsaw volatility, not a directional bet. Understand why this moment is so critical. We need a historical case study. Go back to 1994 and 1995. When the Fed completely misread the productivity boom from early internet technology. In February 1994, Alan Greenspan started raising rates because he saw low unemployment and feared wage inflation. But he missed that technology was driving productivity gains that allowed the economy to run hotter without inflation. The Fed raised rates 7 times in 12 months, causing a bond market massacre and nearly triggering a recession. By 1995, they had to reverse course as the data proved them wrong. The parallel to April 2026 is striking, but with one critical difference. In 1994, the productivity shock was gradual and took years to show up in the data. In 2026, AI-driven transformation is happening in quarters, not decades. The Fed's reaction function is too slow for the speed of this structural change. That lag creates the repricing opportunity. When the FOMC releases their statement on Wednesday, watch for any language acknowledging evolving productivity dynamics or structural shifts in the inflation process. If that language appears, it signals the Fed knows their models are breaking, and markets will front-run the policy adjustment. If the statement ignores AI entirely and focuses on backward-looking employment data, expect institutional desks to sell the Fed's credibility and position for a policy error correction in Q3. Then, when GDP data hits on Thursday and PCE data follows on Friday, you will see the repricing accelerate. If GDP growth exceeds 3% while core PCE stays below 2.5%, that confirms the AI productivity thesis and forces a complete reset of rate expectations. Retail investors will be stuck in yesterday's narrative while smart money has already repositioned. The concentration risk in mega-cap tech is the hidden danger here. The top 7 stocks in the S&P 500 now represent 32% of the index weight. If AI productivity proves real, those stocks will pull the entire market higher. But if the Fed misreads the data and over-tightens, the concentration becomes a leverage point for downside volatility. This is why institutional desks are hedging with both long volatility positions and short duration exposure. The next 48 hours will determine whether we are entering a new macro regime or if the Fed's gamble pays off. Either way, the repricing will be violent, and positioning matters more than prediction. Smart money is not trying to guess the Fed's next move. They are building portfolios that profit from the volatility created by the Fed's uncertainty. That is the institutional edge retail investors need to understand. The macro game in April 2026 is not about being right on direction. It is about recognizing when the rules of the game are changing and positioning for the chaos that follows. This is not financial advice, but it is the reality of how institutional capital is positioning right now, while retail waits for clarity that will never come before the move happens.